Markets in Asia were mixed as investors await the outcome of the meeting from the Federal Reserve. We did have a meeting coming out of the Bank of Japan where the central bank raised its benchmark interest rate in March to a range of 0 to 0.1% from minus 0.1%. The Nikkei index gaining 0.25%, while the Hang Seng index slipping 0.7% and the Shanghai Composite falling over 1%. Hong Kong's Hang Seng index was in negative territory along with China's Shanghai index, which fell 0.8%. The Nikkei at some point rising 0.2%. And then we did see India's markets, which was slightly higher at the close of trade. When it comes to U.S. stocks, they ended slightly higher overnight, although investors were cautious ahead of tomorrow's CPI report, as well as the Federal Reserve's policy meeting. Providing some support to the Nasdaq and the S&P 500, we saw Nvidia shares gaining slightly in the session after a 10-for-1 stock split. The U.S. CPI report for May is due tomorrow alongside the conclusion of the Federal Reserve's two-day policy meeting. The S&P 500 closed positively, gaining 0.25%. The Nasdaq Composite gaining 0.3%, and the Dow Jones also in positive territory. That closed 0.2%. Locally, the JSE is weaker, with the all-share index falling 0.33% to just over 75,000 points. The rand currently trading at 18 rand 67 cents. The pound at 23.79 and the euro trading at 20 rand 05. When we look at the commodity markets, gold trading at $2,306, platinum $958 per ounce, while a barrel of Brent crude will cost you $81.31 a barrel. To help us unpack the markets a bit further, we are joined by Martin Smith, who's a portfolio manager at Anchor Capital. Martin, thank you so much for your time. Given the jobs report that we got on Friday, and as we inch closer to that CPI print for tomorrow that is coming out, as well as the Federal Reserve's policy meeting, what's market sentiment like?
So look, I mean, offshore just seems to be optimistically, fairly optimistic, cautiously optimistic, actually, I should say. I think the market continues to grind higher. And yes, you've had the story of interest rates kind of starting off at 6 to 7 penciled in for the beginning of the year, now probably 1 or 2 by the end of the year. So you've had that story kind of unfold, but markets continue just to tick along. And like I've said, grind higher, I think, is a very good way to describe what's going on in offshore markets. So cautiously optimistic. Obviously, like you mentioned, we've got those two events tomorrow, and we'll be very much governed by what happens there.
Speaking of that narrative change that we saw when it comes to the number of rate cut calls, have you as Anchor Capital adjusted your own rate cut calls, or are you at a point where at this point you think there are no rate cuts in the US?
No, it's definitely been a moving target this year, along for everyone as well as ourselves. I think we're probably at between 1 and 2 at the moment. But again, as we've seen over the last 18 months, I think you very much are data dependent. And you had that pretty strong payrolls number last week, which maybe speaks to a not cutting rate high type of scenario for the rest of the year. But again, I think we'll just be very much event and data driven over the next few months. And tomorrow's quite a big one from that regard. So 1 and 2 for now, but as we've seen over the last 18 months, very, very, very much a moving target.
We had Premier Group release their full year numbers early this morning. The share price is up 4%. What was the key takeaway or the highlight for you when you look at those figures?
Yeah, so again, 4% up, a little bit illiquid, the stock, but very good set of numbers, very strong set of numbers from the business. Also declared a dividend, which the market liked. Debt levels also looked pretty good there. And I think they're delivering on the kind of investment case they put forward to the markets when they listed. So I think it's looking good, and they're executing well. And it's one that we actually are warming to a bit inside of Anchor.
Okay, so this week we are waiting results from Spar and MultiChoice, but I want to talk Spar for a bit. I mean, given the trading update that they released a few days ago, I mean, in the 6 months to March, things have only gotten worse. What are the questions you're asking yourself when you look at Spar?
So we got some detail from that trading statement, but I think the big things to look out for is, one, what does their debt profile look like, kind of a bit more of a granular detail. a bit more information about the exit of Poland. I think that's going to be quite a key thing. And then also just to see what's happening from a momentum perspective inside the SA business and how that's looking and how margins are going. So I think those are kind of the three big things that I would be looking for from these Spar results this week.
Let's talk about MultiChoice, because their picture didn't look any particularly great, especially in that trading statement, with some analysts joking that perhaps Canal Plus is playing the long game here. What are you going to be paying attention to when MultiChoice releases their numbers?
You're right. It wasn't. I think it was 30 to 40 down from a HEPS number is what they guided to, which isn't a great outcome and not what the market was expecting. But that share price obviously holding up because of that offer that's on the table, which you mentioned. So I think a lot of it's going to be focused on that as opposed to the kind of underlying performance of the business. So probably a bit more detail around the offer, how that's going, deadlines and the like. So I think that's the big focus for the share price at the moment, not performance, because even after that trading update, which wasn't great last week, you saw the share price not really move too much because, again, it's all about the corporate action at the moment.
Let's talk the performance of the retail sector so far this year. What's your take on it?
So, I mean, if you look at just kind of the underlying retail index, it's down since the beginning of the year, and that kind of makes sense intuitively, right? You've got an environment of higher interest rates, constraining consumers, load shedding, obviously, towards at the beginning of the year was a lot more prevalent than it had been the last kind of month or two. So there was a lot of things kind of in the base that was making it quite difficult for these retailers, a lot of headwinds. But where we are at the moment, things might be starting to change. And you also may be protected from a valuation perspective with a lot of these retailers. They're looking cheap from a share price perspective. And you've got an environment where interest rates might go down a little bit towards the back end of this year. You've also got an environment where load shedding seems to be a lot better than it was a year ago. And that kind of cost of diesel and all those things is now going to be out of these kind of income statements. So I think things are looking a lot better going forward for the retailers. And I think it might be a good medium-term opportunity to start looking to pick some of those shares up.
All right, Martin, we'll leave it there. Perhaps in our next conversation, we can talk about which aspects or categories of that retail sector you might want to pick at. But thank you so much for your time. That is Martin Smith, who's a portfolio manager at Anchor Capital.